Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of the confusing world of finance. So Pruco Life Insurance Company has dropped their latest filing, and let me tell you, there are some interesting numbers in here, especially if you are into the nitty-gritty of how insurance companies make and spend their money. Before we dive in, make sure you hit that subscribe button to catch all our deep dives and join our disfiling. Cord community linked in the description to keep the conversation going with fellow finance fans. Alright, so Pruco Life Insurance Company, also known by its parent company Prudential Financial, is giving us a look at their finances for the third quarter ending the 30th of September 2025. And let me tell you, the numbers tell a story of growth and some pretty significant shifts in their business strategy. First off, let's look at the overall size of the company. You can see here that as of the 7th of November 2025, they had 250,000 shares of common stock outstanding, and get this, all of it was owned by the Prudential Insurance Company of America. That means this is a company that is entirely tucked under a larger umbrella, which is pretty typical in the insurance world. Now let's get into the main event, the financial statements, and specifically the statement of financial position. This table is like a snapshot of the company's assets and liabilities at a specific moment in time. Check this out. On the 30th of September 2025, Pruco Life had a staggering $46 billion worth of fixed maturity securities available for sale, according to their amortized cost, which is a big jump from 30. $7 billion at the end of 2024, this indicates they are putting a lot more money into these types of investments, essentially buying up a lot more bonds and similar fixed income assets. This is a huge increase in their investment portfolio, a signal they are actively using their capital to generate returns. Moving on to loans, they have almost $10 billion in commercial mortgage, and other loans an increase from nearly $8 billion at the end of 2024. This means they are also increasing their lending in the commercial real estate and agricultural sectors. This is a bit of a riskier move than holding bonds, but can offer higher returns. And the grand total for all their investments combined is over $65 billion in 2025, up from about $53 billion in 2024. That is a massive $13 billion increase in just 9 months. They are definitely investing heavily. Interestingly, their cash and cash equivalents actually dropped significantly from over $3 billion to about $2.2 billion. This might seem concerning, but it makes sense if they are actively investing that cash into those bonds and loans we just talked about. Now, for the liabilities, the biggest chunk by far is policyholders' account balances, totaling over $82 billion in 2025, compared to $69 billion in 2024. This means more people are putting their money into Pruco Life's insurance and annuity products, which is a good sign for their core business. Then we have future policy benefits, almost $27 billion in 2025, up from $25 billion in 2024. This is the money they've set aside to pay out on future insurance claims and annuity payments. That increase shows they are taking on more long-term liabilities, which is expected as their business grows. Overall, their total liabilities are nearing $250 billion. That might sound like a lot, but it is balanced by their assets, making the company appear financially sound on paper. In the equity section, they have common stock with a par value of $10 and $2.5 million. Outstanding, this is relatively tiny compared to their overall assets and liabilities, and reflects that they are a subsidiary owned by Prudential Insurance. Their additional paid-in capital is over $5.4 billion, which represents the money invested in the company by its owners beyond the par value of the stock. This number also grew significantly, showing more investment from the parent company. And finally, retained earnings. They've gone from a deficit of nearly $600 million at the end of 2024 to positive retained earnings of over $588 million in 2025. This is a massive swing, largely due to that revenue growth we saw earlier. They are becoming much more profitable. Looking at the statement of operations here is where we see the profit and loss. For the 9 months ended the 30th of September 2025, they had a net income of over $326 million compared to almost $270 million in the same period of 2024. That is a healthy increase in profit year over year. Their premiums are up significantly as well, over $400 million in 2025 compared to $284 million in 2024. This shows their core insurance business is performing well. Net investment income also saw a substantial rise from nearly $1.7 billion in 2024 to over $2.3 billion in 2025. This growth is clearly fueled by their increased investments we saw earlier, and likely higher interest rates playing a role. Now this is interesting. Realized investment gains and losses actually swung from a gain of $150,000 in 2024 to a loss of over $1.2 billion in 2025. This is a pretty big hit, but looking closely, it seems to be driven by their derivative trades, which can be volatile. On the expense side, policyholders' benefits went way down from over $4.3 billion in 2024 to about $600 million in 2025. This big drop is likely likely due to the absence of certain large reinsurance, related expenses from the prior year that we saw mentioned elsewhere in the filing, and they're amortizing less deferred policy acquisition costs in 2025, which aligns with their increased investment income. It is a complex accounting adjustment that generally means they are recognizing the costs over a longer period as their profits come in over time. And the bottom line for Pruco Life Insurance Company, after all these ups and downs, they managed a net income attributable to them of over $315 million in 2025. That's a solid increase from about $260 million in 2024. Now let's talk about what could go wrong, because no company is without its risks. Pruco Life is facing several big ones. First up, they could lose money on their investments if companies they've invested in start performing poorly, or if their partners in financial deals can't hold up their end of the bargain. This is a constant threat for any investment-heavy company. They also have guarantees in some of their products that are tied to market performance. This means if markets go south, their earnings could take a hit or their financial results could become more unpredictable. This is a classic insurance quandary, balancing growth with potential downside. And like any financial institution, they are heavily exposed to changes in regulations. This includes new tax laws, rules about how they handle customer money, and even privacy laws. Any shifts here could mean new costs or new ways of doing business. Okay, let's shift gears and look at how management sees things. The MD.A section is management's own take on their performance. They report that their total assets grew by a huge $17.5 billion. This is largely due to them investing more in fixed maturities like bonds and securities, and also growing their commercial loan portfolio. On the liability side, policyholder account balances shot up by $13.1 billion. This boom is linked to more people buying indexed annuity products, essentially betting on market growth while having some safety net. And their total equity, the company's net worth, saw a solid $1.5 billion increase. This was boosted by investment gains, a capital injection from their parent, and of course their net income. That is a good sign for the company's underlying financial health. Interestingly, their total revenues for the first 9 months of 2025 actually went down compared to 2024 by about $3.3 billion. They blame a big chunk of this on adjustments from their annual reviews of assumptions and other refinements, basically accounting for things differently. This means we have to look past the headline number to understand the true operational performance. However, their benefits and expenses also dropped significantly by over $3 billion for the 9-month period. This is mainly because they didn't have the same large reinsurance recapture expenses in 2025 as they did in 2024. That means the underlying business might be more stable than these large swings suggest. Let's talk about the risks associated with their fixed annuity products. The main problem here is the company guaranteeing a minimum interest rate. This can be a real challenge if market interest rates stay low for too long. They manage this by adjusting credit rates, which is smart, and also by using things like surrender charges in the early years to make sure people don't just pull money out too quickly. For variable annuities, the risks are more about predicting how customers will behave, like when they'll annuitize or withdraw money, and how the stock market will perform. They use something called an asset liability management strategy, or ARM. To try and match their assets with their future obligations, this involves using a mix of investments and derivatives, e.g. QI, tie futures, interest rate swaps, and options to try and smooth out the bumps. So what is the big picture here? Pruco Life Insurance is clearly growing its investment base and getting more money from policyholders. At the same time, they are managing significant risks from market volatility, and product guarantees their profit is up, but watch those investment gains and losses closely, that derivative. Trading can be a wild card. Also, that big drop in revenues for the 9-month period needs a closer look beyond the accounting adjustments to see what is truly happening with their sales and operational performance. Overall, they seem to be navigating a complex environment with a focus on investment and cautious risk management. It is a balancing act, and we'll be watching to see how they do now for my take on Pru. Co-Life Insurance Company, on the strength side, they are clearly attracting more customer money and growing their investment portfolio. That is a solid foundation. The profit increase is also a good sign, showing they are managing their business effectively. However, those massive swings we saw in realized investment gains and losses, especially due to derivatives, are a concern. While they can lead to big wins, they can also lead to big losses and make their profit less predictable. The company is also exposed to market risk through its product guarantees, which means that if the market takes a downturn, their profitability could be seriously impacted. It is like they're betting on the market for their customers, but if the bet doesn't pay off, they might have to cover the difference. They are trying to mitigate these risks through investing in safer assets and using derivatives to hedge, but it is still a notable risk. Also, the slight dip in revenue for the 9-month period needs scrutiny. While they explained it with accounting adjustments, it is always worth keeping an eye on the actual sales trends. For opportunities, Pruco Life is well positioned to benefit from any rise in interest rates which would boost their investment income, and potentially the returns on their annuity products. They are also seeing growth in their indexed annuity products, which is a smart play that balances market growth potential with some protection for customers. The major risk remains the market itself and regulatory changes, as we discussed. Any significant downturn in the economy or unexpected new regulations could pose a significant challenge. In conclusion, Pruco Life is a large insurance player with a growing investment portfolio and a decent profit increase. They are actively managing risks, but the inherent volatility of the insurance and financial markets means things can change quickly. For investors and customers, it is about understanding these risks and how they are being managed. What do you think about Pruco Life's latest filing? Are you impressed by their growth or concerned about their risks? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a like and subscribe for more corporate deep dives. And remember to join the Discord community, linked in the description, to continue the conversation. Thanks for watching, and I'll see you on the next episode of Corporate Decoder.